Okay, Jesse, let me ask you something. If I told you that a deal usually returns 6 to 7%, how would you feel about 9%?
Great.
Okay. Now, what if I told you that most investors are actually targeting 15 to 18%?
Whoa.
How do you feel about 9%?
That's not as great.
Okay, so same deal, same risk, but a totally different feeling.
Yeah.
Right?
Yes.
And so
Sure.
nothing else has changed except the anchoring that I did at the beginning of it, which is what we're going to talk about
tricky.
today on the Furlo Capital Real Estate
Mind
Podcast,
games.
where we're diving into the mind games of real estate investing. That's right. And our mission is to equip people to invest wisely, especially in those kind of situations, so that together, in both property and people, so that together we can build wealth while improving housing. I'm James, and this is my mind-bent wife, Jessie.
This is good. It feels like some parenting strategy I could start utilizing or something to make my kids think that chores are amazing.
Okay, sure. Yeah,
You know,
100%.
I mean, sometimes I try to go there. I'm like, this could be so much worse. I'm like, yeah, right.
Yeah, right.
But if I had a concrete example where I was like, I don't know. All right, I'm gonna listen closely.
Okay.
To these strategies.
This,
here.
for the record, is not a
Anchoring.
parenting podcast.
It's not.
This
This
is
is
about
real
real estate
estate,
investing.
however.
But I guess there are things that transcend
Yeah, these
all of
things
it.
can be applicable in multiple situations.
So we're going to talk about anchoring, which is it's the brain's tendency to rely too heavily on the first reference point that it encounters when making decisions under uncertainty.
Okay,
Okay.
it's very specific.
And so once it's set, everything else is judged relative to that anchor.
Yeah.
And it's not objectively at all. Okay.
Yeah.
So here's another fun one example. Feel free to play along at home. Let's talk about Gandhi real quick.
Okay.
Do you think that when Gandhi died, he was older than 114 years old?
No.
How old do you think he was when he died?
I don't know. Like in his 90s, I guess.
Okay, interesting. Now, what if I had asked it a little bit differently and said, let's talk about Gandhi again. Do you think Gandhi was older than 35 years old when he died?
Yes, but now you have me doudting whether he got into his 90s. You're right.
That is the
That
power
totally
of
works.
anchoring right there. Yep.
See, I would say okay, well maybe he was in his 70s or 80s.
Oh, yeah.
Are you actually going to tell me how old he was when he died?
I actually have no idea. I
my
didn't look
word.
it up. That's
Okay.
just a classic
He was
example
old.
that
He
people
was
use.
old, I think.
I don't know. We're just
This is gonna bother me.
No, so everyone can be so you can settle yourself now. We are not going to close that loop. I don't know the answer.
You can look that up on your own,
Yeah.
which I will do
Sorry.
after filming this.
Sorry.
I am going to look it up because now I have to know.
You're welcome.
Oh,
Yes.
my word.
And,
Troublemaker.
But that's the example, right? And this is why
That's weird. That's weird. It's like a psychological flaw. We're like, why? Why would that influence my thinking so much?
Yes, which if you think about it, why this is so important is if you're thinking about investing in something, there's a couple unknowns.
Yes.
And how the sponsor frames it is really important.
It's
Right?
true.
Yeah.
It's so true.
Yeah.
They could, yeah, push you one way or the other just by changing a single number.
Yeah. No, it's true. And in some
the
ways we're
price
talking about
or
the
the
difference between
return or
overpromising, under delivering,
Sure.
or under promise, over deliver. Like
Sure.
that's that exact same idea.
Yeah. Yes.
That's in play here.
Wow. Okay.
And-
Keep going. I'm
Okay.
fascinated.
Cool. So the problem that say high net worth investors have is that they're successful.
Sure.
And so oftentimes what they'll do is they will create anchors of massive success.
oh.
So like, for example, they might say like, well, my first deal returned like 22%. It was amazing. So now I anticipate all of them. You and I, we dealt with this with our Lion Apartments, right? We regularly had to tell ourselves, because we talk about once in a lifetime, unbelievable, amazing deal. Is how we talk about it, because it has an average annual return of 144%. It's unbelievably
insane.
good, and we know it, and we just
And
need
yet,
to be and we just need to be conscious of like, okay, like yes, that is great.
you can't
But-
compare everything to that. That is
Correct.
not the norm.
Yeah,
It's an outlier. Yeah.
Correct. And so that's you just got to be aware of it. And I think again, people who have a high net worth are successful, and they're used to those
a
kind
high
of things.
return
Yes,
in general.
and they'll also have other anchors that kind of creep in on them, where they'll ask questions like, "Well, what will my peers think about this?" Or "Is this deal impressive enough?"
Sure.
And oftentimes an anchor can be, because it can be tied to identity, not just the math.
That's so interesting. Like what's the amount that somebody else, or what's the value associated with each amount?
Yeah.
Or return.
Yeah.
Or whatever, you know,
well,
whatever
I think about like
is.
Baker Tower, right? Like that's one where the numbers were good, but it's an impressive, cool building.
Cool. Yeah.
And I've potentially run the risk of people like, well, this one's just a normal deal. Where's the cool historical building? Like that could be a thing, right? And that's something I need to be aware of looking into the next deal. And also just being aware of like, yeah, some deals are amazing. Some deals are less than amazing, and it's okay. Okay. Ready to try another experiment here? What do you think is a good annual return for passive real estate right now?
Well, I personally, I would want a pretty high return. like 10% pops into my mind or more.
10% or more. Okay.
Because it's like,
fair enough.
I don't know. I feel like I could get that other places.
Okay, interesting.
So,
now, what if I told you that institutional capital, we're talking about the big investors, they're thrilled with a 6 to 7% stabilized yield? Now,
then I should probably be happy with.
How does a 9% deal feel?
Yeah, it feels pretty good.
And so, again, same asset, same risk, but you get a very different emotional reaction based on them. And that's the thing, right? Anchors, they don't change the spreadsheet. They change your level of satisfaction with a deal.
Weird.
Yeah.
Yeah, because if you were looking at the same deal, this 9% deal, in all of these different scenarios or circumstances, the deal hasn't changed. It's exactly the same.
It's the same deal.
Same numbers, same return.
It's all about expectations.
That's weird.
Yeah. No, it's true. So there's other places where it also shows up beyond just price. So you can get it and that's typically, okay, let me take a step back here. Typically, anchoring is talked about in price negotiations.
Okay.
Right? And they'll say, and that's where they'll say, you want to say things that, if you're trying to get the price to be higher and you're selling it, you might talk about all the time and energy and effort that went into making this thing. Therefore, you are now valuing it more because they go, oh, wow, look at all they did. Look at all they put into it. It must be worth a lot. And then when you come back and say, and this is the price, they go, oh my gosh, what a deal relative to in my mind what I had thought it was. And same thing, you see it on the buyer side where you might be like, well, I can go get this alternative asset for a whole lot less. Why would I ever pay more? And those are the kind of the discussions. So it often is around price. That's where anchors, that's like classically where they were talked about in negotiations. Yeah. But again, they show up in other places. Something you're gonna ask something there.
Two situations pop into my head where I'm like, it seems similar to like if you're negotiating like a salary or something, and you're like 100%. Going in for an interview, and your boss says this, then you do this. It's like this countering type concept, and that it's exactly the same. But I think like what you're saying, I'm thinking of some properties we walked into very early on, where it's the same property, and yet you walk in and go, oh yeah, opportunity, this is fantastic, and I go, oh my gosh, we have to get out of here right now. This is terrible, and it's like just your view on what you're placing value on and how it's anchored is totally different. It gives you a totally different perspective.
No, totally true. Yeah. Yes, very much. Yeah. And maybe another word for like anchoring is like, what are your prior expectations? But the idea behind anchoring is it is this, you can get yourself, it's like, well, what are those expectations based off of? Right. That's the anchor. Yeah, no, totally. So there's some other ones. It could be off of returns, right? Which is the examples that we've been giving over and over, right? You can have that IRR that's at the beginning. And this is what's so hard about it, right? Even if you know what's going on and I do the game with you, even you were like, because like the Gandhi thing, I don't know if he was around 90, right? He might actually be closer to like 40. You have no idea.
I don't know.
But you were still instinctively going higher because even though you knew that was what was happening, you can't get rid of that first one. That's how powerful it is. And so like when you're looking at a slide deck and they give a number at the very beginning,
Yeah.
That's the
That's
number.
the number.
Like, even if they go, oh, we had to revise it later. Nope. Too bad. Like, it's like, this is it. Market cycles can often be anchors, right? And you think about, I thought this was interesting. Interest rates these days, are they expensive or are they not? Right.
Depends. Yeah.
Yeah. There used to be a time when people were thrilled to get 6.5%. And then remember, we're like, oh my gosh, I have to pay 6.5%. This is ridiculous. So expensive. You can't do any deals. You're like, what are you talking about?
Yeah.
People do deals. This used to be unbelievably cheap debt. And now it's like, oh, this is so expensive. So you get those kind of market swing anchors. Also just appreciation, right? I know for years we have had just rent just going up and up and up, right? This last 6 months to a year, it's been flat in Oregon. And I mean, even myself, I'm like, wish I get it. Like, inflation is still going up, so technically real rents are going down. So it is actually a negative thing. But I've been used to like, no, it just trends up with rent, like, or with inflation. This is what it does, even better than it. It's a, quote, a hedge against inflation. I have talked about that multiple times. That has not been true this last year, so I don't really mention it. But that's one of those things where
you've anchored at one point.
Reputation is one, right? If an investor does a really good deal, it's kind of a halo effect around them.
Okay, sure.
Or if they have a bad quarter, like you might just overreact and be like, this guy's a dummy, he doesn't know what he's doing. Which reputation is really important.
Yeah.
But they're anchors, right? And that's maybe another, like, there's a halo effect is probably it's probably a similarly related, but that's more, actually that might be the opposite, because halo is all about you're influenced by the most recent stuff. But in some ways, it can still act as a more immediate anchor on it. Yeah. All right. Let's do another deal or another experiment. Okay, because I know you're loving these.
Yeah, I do. It's strange to me.
Okay, we got two deals. Deal number one. This deal targets an 18% IRR, but may settle closer to 12%. Okay? Deal number two. This deal is designed for a stable 10 to 12% return with limited downside. Okay? So, which investment, A or B, feels safer to you? I can repeat them again if you want.
Well, I'm catching on now. I'm paying attention. So they're both 12%. But it seems like the second one, because you said that was like low risk and it
okay.
stayed there. The change was a
but,
lot smaller.
Okay, next question. But which one feels a little bit more disappointing?
The second one.
Right?
Yeah.
Even though I told you it could be as high as 18, but it's probably going to settle around 12.
That's because in my mind I'm thinking, but it could be 18.
But it could be.
Like, that one's on.
So here's another.
It's just lower.
Here's the next question. Which one would you rather talk about and defend at a dinner party?
The first one.
Right?
Because there's.
Even though
could be.
It is the exact same deal.
Yeah, but it could be.
But it's
way better.
But the other one could be way better too. That's the point. We're talking about the same deal. That's the thing.
That's true. You're describing it differently, but it's the same deal.
Yeah, of course I'm targeting an 18%. I always target an 18%. Duh. But realistically, it's going to be around 12.
Here's where it's going to fall.
But on the other one, I'm like, realistically, it's going to be 10 to 12, but it's probably going to be 12.
You could just make all your deals sound incredible by anchoring them or framing them with the like.
Yes, but then you have the flip side, right? If I tell you, oh, it could be 18, but it's really like, but it might settle down to 12. And then when it's 12, how are you going to feel about it?
Yeah, I'm like, oh, well, it could have been 18. How come it wasn't there?
For me as a sponsor, I've opted for the second style of like, no, I'm going to be pretty conservative. Like, I know I can hit this number.
Which honestly is way smarter because
in the
it's
long
like
run,
in the long run it is. In the short run, it's like, well, yeah, I'm not as excited about it. I'm not hyped up. But if you undersell and then over deliver, I'm gonna be like, oh, okay, like yeah, you said, it could be 10, 11. I got 12.
No, totally.
I'd be like, oh yeah, all right, I'll invest again. That's great.
Well, and it's funny. So I'll do stuff. I'll admit this on camera. I'll do things where I will say like, hey, yeah, this is designed for a stable 10 to 12% return with limited downside. And then I'll take it a step further and go, and I use conservative estimates. So now what I've done is
probably going to be
without giving you a number, I've told you it could be higher, and I let you fill in the blank with whatever you want. I let you anchor yourself up, and you go, oh, that sounds pretty good. which is like, and part of it, there's definitely truth to that. I was conservative on all the estimates, but like I was totally, it's the game. And yeah, it's an interesting
psychology.
So it's like, yeah, how do you, but as an investor looking at deals, you just got to be aware that's what's happening and to say, okay, I just got anchored. I'm having an emotional response, but what's the math?
Anchored is the new triggered. I just got anchored. But let me just settle down here.
Dude, that should be. I like where your head's at on this one.
It's just seems funny.
Could be the new
Did you just anchor me?
Did you just anchor me?
I feel anchored right now.
Dude.
Next time I notice you doing this, like in our real lives, I'm gonna be like,
I'm excited for you to do this in a work meeting and just be like, I just feel anchored right now.
I feel anchored.
Which you're not gonna be like, oh, that's so nice, because it has that like feel grounded. Like, no, this is bad.
No,
anchored is bad. If you go, did you just anchor me? That's gonna be the.
Anchor me.
Oh, I love it. That's awesome. So obviously, there's some costs to doing bad anchors, right?
Yes.
Which you could either like you could do all sorts of stuff. You could over optimize. You could it's just setting the wrong expectations. You could be chasing returns and ignoring the risk. That's probably the biggest one.
Yeah.
You could be sponsor hopping because you're constantly like because if you have this if you have a bad anchor and it doesn't work, you move on.
Oh,
and you're just doing shallow
It's not
diligence.
necessarily a bad deal. It's a bad anchor.
Yeah.
Oh.
And again, anchors don't usually cause losses. They cause inaction and miscalculation and disappointment with whatever it is. Because the deal is the deal. Like, that is what it is. So here's some things that you can do to re-anchor yourself if you want to. The first one, instead of saying, hey, this deal returns a 14%, you can give it some sort of distribution. Just build in the hedge right to begin with. And that's something I can do. That's something I don't typically. But because it gets too confusing to say like, oh, it's between this range. It's a lot easier to say that. And again, you can remember like you can anchor to a process, not an outcome. So care about like, oh, this is how they make decisions, or this is how they set up the capital stack, or this is what they do in downside scenarios. Like again, like focus on behavior, not necessarily what the outcomes are.
Like use one of those examples before, like the 12% deal or the 9% deal.
So like you might say something like, well, in terms of a process, where I might say I only ever like when we were first investing, we never modeled in appreciation. Just didn't do it. You said a deal has to make sense
without it
day one.
Yeah.
Right. Like
then
that
I
was
know
our
it
thing.
definitely will with it.
And that's a process anchor.
Yep.
Right up ahead, something we know we're doing. Yeah. And it's all about process.
Interesting.
Yeah. I do, again, it was like a lot of the assumptions that I do, I build in. That's where I anchor low. I tell everyone about it, hoping that they, in their own mind, do the math to anchor it up, but whatever. Yeah. So again, anchoring, it quietly shapes how satisfied you feel with the same outcome. And so the real question isn't what return you're targeting, it's who set that target in the first place. Right. And so next time you're evaluating a deal, you want to ask yourself, am I analyzing the investment or am I defending an anchor? So there you go. Anchoring.
Man,
super powerful.
Good stuff.
Really interesting.
We do it all the time.
Oh, totally. I mean, it's a nice shortcut that's super helpful.
Sure. It is. I mean, we do it all the time with like groceries and how expensive they are and relative to what it was and like gas prices, but also just, I'm thinking of like attendance numbers, for different events that I've planned. And I'm like, oh yeah, I ran this event, got 35 people, I ran it again, got more than double, but it wasn't the anchor that I had set for myself. Yeah. And so I was like, nah, was it really that great? And it's like, are you kidding me? It was more than double what you had last time. Like, that's great.
Right.
So we do it all the time.
And it's really important for when you walk into unknown situations.
Yeah.
And then it impacts, again, the situation is what it is. It's really just what's your interpretation of it.
Yeah. How are you feeling about it? And
yeah. And again, you don't want to be unrealistic and fool yourself into saying like a bad investment was a good one, actually.
Yeah.
Well, I could have lost a lot of money. I only lost a little.
That's just as risky, just as bad. Yeah.
Yeah. No, totally. It's just you just want to be aware of it. So yeah.
Okay. I got to go look up Gandhi's age now.
That's right. I had totally forgotten. I don't actually care.
It's still in my brain.
Man. Oh, I am so excited to feel free to leave a comment on his actual age. I'm totally in on that. That'd be great. So with that, if you'd like to learn more about investing with us, you can check us out at furlo.com. Wow. With that, thanks for listening. Have a great day.